U.S. consumer sentiment rose slightly in November, reflecting stark divisions between Republicans and Democrats regarding the economic outlook following Donald Trump's presidential election victory. The University of Michigan's final November index climbed 1.3 points from the prior month to 71.8. Data showed Friday, while this is the highest level since April, it's below the preliminary reading of 73, which was based on responses collected prior to the election. A measure of sentiment among Republicans surged in November to its highest level since 2021, while confidence among Democrats fell to its lowest in more than a year. Independents reported a slight decline in sentiment. Historically, consumers who align politically with the party in power tend to have a more favorable view of the economy compared to those affiliated with the opposition. Joanne Shu, director of the survey, noted that substantial uncertainty remains about how Trump's economic policies will be implemented. Consumers are likely to continue revising their outlooks in the coming months. The report also highlighted a drop in consumers' one-year inflation expectations to 2.6%, the lowest level since 2020. Meanwhile, long-term inflation expectations rose to 3.2%, up from 3% in October, marking the highest level since November 2023. While Republicans were more optimistic about inflation trends, Democrats expressed growing concerns, citing worsening expectations regarding inflation, personal income, labor markets, and overall business conditions. Despite optimism from some Americans that Trump's policies might improve their financial prospects, many economists have warned that measures such as tariffs, deportation of undocumented immigrants, and tax cuts could drive inflation higher and hinder economic growth. Business activity. The Consumer Sentiment Survey contrasts with separate data released Friday, showing increased optimism among businesses following Trump's victory. The S&P Global Flash November Composite Index for manufacturers and service providers advanced to its highest level since April 2022. This aligns with recent positive surveys for small businesses and home builders. At the same time, Bloomberg's latest monthly survey of economists indicated that the Federal Reserve is expected to take a more cautious approach to interest rate cuts next year, given persistent inflation and limited prospects for significant price relief under Trump's leadership. The University of Michigan's current conditions gauge fell to 63.9 from the prior month, while the expectations index rose to 76.9, its highest level since March. Consumers' outlook for their financial situation improved in November, reaching a 7-month high. More news: Europe is already facing its next energy crisis. Gas reserves are rapidly diminishing, and impending supply cuts from Moscow could trigger a new energy crisis for Europe, which is still recovering from severe shocks experienced 2 years ago. Rising tensions in Ukraine have led to a nearly 45% increase in gas prices this year. Although prices remain significantly lower than the records set in 2022, they are sufficiently high to exacerbate the cost of living crisis for households and increase competitive pressures on struggling manufacturers. Gas storage serves as a crucial resource during the coldest months, but this year's inventories are quickly dwindling due to increased heating demand from cold weather and a lack of wind, which has heightened the need for gas in power generation. More than 2 years after President Vladimir Putin leveraged energy as a weapon, Europe is facing challenges in securing its energy supply. The tight market highlights the continent's struggle to completely eliminate reliance on Russian fossil fuels. The situation is expected to worsen as gas deliveries that had previously helped replenish reserves in 2024 are likely to be unavailable next year, further driving up prices. We are still facing issues with gas supply, stated Marcus Kreber, CEO of RWE Ag, during a conference on Friday. If we genuinely want to achieve independence from Russian gas, we need to enhance our import capacity, and we will likely encounter this issue again this winter, as gas storage facilities are depleting rapidly with a cold start to the season. The conflict in Ukraine is intensifying, with both sides conducting missile strikes this week in a bid to gain leverage ahead of Donald Trump's potential return to the White House. In response to the escalating tensions, the U.S. has imposed sanctions on Gazprombank, the last significant financial institution that was exempt from penalties and responsible for processing payments for Russian gas. These sanctions are intended to reduce the Kremlin's revenue from energy exports, but they also heighten the risk of a disruption in the natural gas supply that still reaches several Central European countries. While Europe has made strides in decreasing its dependence on Russian energy, losing one of the final remaining pipeline gas routes could further strain the gas market and drive global prices up. According to analysts from Energy Aspects, Europe was already preparing for the potential cessation of Russian gas flows through Ukraine when a transit agreement expires at the end of the year. The sanctions could lead to a halt in gas supplies even before that deadline, with Hungary expressing concerns about its energy security. Current prices reflect the potential loss of remaining inexpensive Russian gas supplies, delays in additional liquefied natural gas, LNG, from the U.S., and the prospect of a cold winter.